What's going on, guys? Dylan from Twin Finance. Before we get into this video, I'm just going to ask you a quick question about mutual funds. Have you ever wondered why there are 4 times as many mutual funds on the market, roughly, than there are stocks? That's something to think about, guys. And that kind of brings me to my point. Well, why do you think mutual funds were invented? Well, obviously, someone had the right idea. They wanted to help other people's future, but they also wanted to help themselves too. They obviously wanted to make some profits. They wanted to make some money for themselves, and they do that off these are 5 main fees, guys, right here. So they do that majority off these fees. The first fee you're gonna pay is a management expense ratio, and that's just to the fund manager for doing what he does to manage that fund. Whether it's like allocating the assets, doing research, the time he puts in, he's gonna need to get paid for that. 12B1 fees, and that's just advertising fees. So like if you want to get more people into your fund, you're not going to do it by not advertising. So you need to pay to advertise to get new money to grow your fund. So that's what a 12B1 fee is. Trailer fees are fees that when, let's say, they trade off stocks and they rebalance their portfolios, and that's the fees they pay after they do that, guys. The front end and back end fees, that's just sales fees. So that's just sales commission fees. So let's say they get stocks and stuff from brokers, and they have to pay a commission on that. Well, then you end up paying that. They take that from the fund. Excess trading fees. So if they start trading more because the market's more volatile and they feel they can make some more money, they start trading more. That fund manager trades more. You're gonna pay those trading fees because it costs to trade, guys. So you're gonna end up paying those fees from your fund. Now I'm going to run you through a quick example of what these funds, let's say they add up to, on average in Canada, it's over 2%. It's like 2.4%. We pay the highest in the world, but in other countries it is lower. So we're going to stick to an average of 2% of these fees adding up to. And I'm going to run you through a quick example of what the power of 2% is, guys. Let's say, on average, let's say you put $500 per month from age 25, well, let's make that 20 actually, because the average retirement is 65. So let's go 20 to 65 years old. If you invested that at a 10% rate into a low cost index fund, or a fund that has, let's say, like a 0.3 or under management fee, and you can get a lot of those through Vanguard, TD in Canada. There's a lot of other options, guys. 10% per year. Average of the S&P over the last 90 years is 10%. So if you said 10% per year, $500 a month for 45 years, your portfolio is looking at 5.2 million, guys. Right in and around that area. If you want to check out those numbers, it's right in and around that area. Just go online to a compound interest calculator, right around there. But let's say, I'll use a different color so we can break this up. Let's say the second scenario, you're still putting 500, right here for you guys, real quick, so we can remember. Now this is low cost. Low cost. Let's say it's like 0.3%. Now this one down here is going to be an actively managed mutual fund. And let's say this one's going to be about 2%, guys. 2% for this fund. So it's the same $500 from 20 to 65. 20 to 65, but instead, let's say that the fund averages 10% returns, but you're paying 2% to be in that fund. So now really your rate of return is only 8% now. And 8% for 45 years opposed to 10% brings your portfolio down to roughly half the amount, guys. Over a 45-year run, your portfolio is now only half the amount of your portfolio would have been in a lower cost fund, guys. And that's why I wanted to show you guys those funds. So the next time you guys think about investing in funds that have high fees, I want you guys to think about how much more your money could be worth when you retire. Like 5.2 million when you retire compared to 2.6, like that's crazy, guys. Like I know that's not what I want to do. So if you guys like this video, remember to subscribe to the channel for more videos on finance like this one. Thank you for watching. Remember to like this video also, and subscribe. Have a great day.